All right, well, we are watching a big sell-off in shares of Facebook's parent Meta this morning, down 15%. Basically a 1-2 story of weakness tied through the sales outlook for the current quarter and the company's fresh spending plans for the year. A lot of that has to do with AI. And look, a lot of companies are being rewarded for betting big on artificial intelligence. But Meta didn't really push away from some of the other spending areas that they've been focusing on. You know, you think about all that metaverse stuff and AR and VR, and their Reality Labs business is still seeing a lot of spending for the year overall. And for a company that had been trying to show more cost discipline on Wall Street, this has not been well received. At the same time, the stock had such a huge move that this sell-off is a reminder that there were some big expectations heading into the quarter, and that is a notable place to continue the conversation with Christine Tan, because we have some big technology companies reporting after the bell in Microsoft and Alphabet. And I guess starting with Meta, what do you make of how the market's mood is this morning around the company?
I mean, the sell-off at sort of face value seems like a lot, but to your point, Meta was up almost 40% year to date on pretty strong expectations. So to some extent, it's just a repricing of that. The concern, as you highlighted, was just around the spending. So Zuckerberg had sort of really focused on the message on the year of efficiency, basically trimming spending on just focusing on what's going to be able to be monetized. And this kind of caught investors off guard a little bit. There's also a little bit of show me in terms of the areas that you're choosing to invest in. The path to monetization isn't as clear as, let's say, with Microsoft, where they're focused on embedding AI into some of their enterprise services, you know, like working with their partners like Coca-Cola as a new partnership. So I think that's what ultimately it's the stock had done extremely well year to date. Expectations are probably high. And then you get this bit of a reminder, hey, you know, we're going to have to spend a lot of money, and we're not clear when that sort of starts to pay off.
You know, it's interesting. We've got Alphabet reporting after the bells tonight. One could argue that the sentiment around that business heading into earnings is very different than with Meta. Not that Alphabet hasn't bet big on AI and has big AI plans, but it has felt like because there's been so much focus on what others have done with AI, that there's been a concern that Alphabet has plenty of competition, but more specifically that its bread and butter business, the search business, could be impacted by, you know, people using chatbots that allow you to get answers on other platforms. You know, people look at, you know, TikTok and Amazon in some ways as competitive as, like, say, a Meta for Alphabet's search business. But I would imagine if they come out and they're like, our search business is pretty good, and our YouTube numbers are pretty good, they actually could please Wall Street, just the way things have been going the last few days. Tesla gets a positive stock reaction for talking about the long term. Meta falls short, even though there were big expectations. It's kind of it's very much an earnings story right now. In other words, like the reactions seem very short term.
That's right.
Yeah.
That's right. And that's what makes it so complicated. So for our equity managers, especially the ones that are more focused on U.S. growth, you have what they expect, and then they have to think about what the market's expecting and what's being priced in the multiples and what the reaction could be. But in the long term, if you do have that kind of focus, you can think about where the long-term cycle looks like, what the revenue sort of monetization business model looks like. To your point on Google, it is interesting where some of the competition is coming in. So you talked about TikTok. Imagine how much TikTok probably knows more about you just through what you view and what you like than maybe a search engine that will only get information when you actually go onto it and you're searching for something. So there are more unusual sources of competition now, but never underestimate Google. I mean, there's a reason why we use the term we're Googling something as opposed to researching something.
Yeah, exactly.
So we'll see what they say.
So when you think about technology as a strategist, how does it fit into portfolio? What's the common thinking right now at SLGI?
It's a great question. So there are two competing forces. On the one hand, we recognize that even notwithstanding what happened with Meta last night, these are sectors that are generally less economically sensitive, especially if you have some kind of linkage to AI and AI spending or a beneficiary of AI spending. But on the other hand, these are long duration companies, so they are more sensitive to rates. And that's why whenever you see concerns about inflation and maybe rates have to stay higher for longer, or the cutting cycle might take years instead of just a couple of years, that has an impact on valuation. So it's that combination of the two. So our managers, though, they're very focused on what do we see in terms of the next 5, 6 years, in terms of is there a competitive moat? And then the other piece of it, which is where the valuation piece comes in, are we overpaying for it? So that's kind of the thought process.
And I guess, if tech doesn't necessarily scream value, but growth has had such a dominant floor game, if you will, over the last, however many
15 years, 16 years, yeah.
Yeah. How are you supposed to toggle between those two strategies?
So we don't really have a growth preference or a value preference because it's, I started out by saying we don't really have a geographic focus. Because within value, you do have some very high quality companies that are using technology to enhance their business model. So they're not as direct or not as exciting as the NVIDIAs or the Metas or the Googles of the world. But it does make a big difference when you have an old school economy business that's utilizing AI, whether it's to make themselves more efficient or to address their customers in a different way. So we're kind of thinking of it broadly. When you talk to our equity managers, they'll say the same thing. It's like, whenever you think AI, the first thought is the obvious, Magnificent Seven, Fabulous Five, whatever you want to call it now. But they're thinking more in terms of how are our businesses that we're invested in using technology and using AI.